background factors, in particular the debt levels in Europe, which are extremely important and also extremely high. And we will obviously explore the imbroglio surrounding Greece. And I come up at the end with 6 scenarios, some of which are overlapping for what might happen next. And as Hans says, we are an independent platform for research and exchange of ideas. And in the context of that, I'm taking a party of investment managers and economists to the Bank of Greece next Monday evening. Next week, we will have a whole series of meetings, I hope, on Tuesday. There are obviously all sorts of rumours swirling around about what might be happening in Greece, but we are going to Greece next week to get an update, and I do hope it will be business as usual when we get there. So if we can just go through the slide, perhaps to the next slide, please, Brian, if I may. In this imbroglio, an intertwining of politics and economics, which, generally speaking, has been rather negative. Monetary union is meant to bring about stability, and there has been stability in nominal terms, but this has marked a great deal of real stability. We see Greece now teetering on the brink. The European Central Bank quantitative easing program decided in January has introduced a lot of system. It has not actually changed anything very much. And of course, just as the United States is preparing to raise interest rates later on this year, this could be a rather negative cocktail. And monetary union was supposed to generate more integration of European economies and European politics. I'm afraid to say that it is doing the opposite. It is promoting more renationalization in some spheres, despite all the efforts that are being made at a political level to bring about more integration. I will not comment this slide too much because we need to go rather fast through the roughly 20 slides, but there is now what I call a great monetary polarization underway, with Japan still pursuing quite aggressive quantitative easing policies, the United States having ceased quantitative easing, the Bank of England as well, and as you all know, the rise in interest rates, which has been postponed for some time in the United States, will take place later this year. The politics of this are pretty unfortunate. We are in the middle of an unpleasant cocktail in Europe, with the Balkan states being unstable and also arc of crisis between Ukraine and the Middle East. If we can go to the next slide, please. Underlying the euro crisis, there has been a move to better economic health, and I will explain this as we go through. Some of the underlying imbalances have improved, but this has been a result, above all, of a massive rise in unemployment and a big fall in activity in the peripheral states. There has not been, I would say, a sustainable improvement in competitiveness. And so the question is whether the peripheral states, which have been in trouble, could really continue to survive and prosper once economic conditions. Regarding the Greek standoff, there are several options here, and I will outline these later on. It could have 2 consequences. If Greece really does leave the euro, that could concentrate the minds massively amongst those who stay and could make people see the bad consequences of a profligate behaviour. On the other hand, if Greece leaves, and this is supposed to be a system that is irrevocable, that no country can leave, so if Greece does leave, other countries might have the idea of doing a similar act. And so one cannot really say, as the Bank of Greece warned in a very strong statement on Wednesday, if Greece were to leave, and that's still a possibility, this could have, quotes, incalculable consequences, end quotes, and it could be, quotes, an uncontrollable crisis, end quotes. And that's from the Bank of Greece, the central bank. One thing I would say to our friends in Asia is that the euro's use in monetary reserves has been declining because of the negative interest rates we now have, and also because of the genuine doubts about the sustainability of the system. So could we have the next slide, please? Yes, the concentration of worries on Greece is really rather large. It's a question of whether 7.2 billion euros in bailout funds will be released by the end of this month so that Greece can meet its obligations to the International Monetary Fund and also to the European Central Bank, which are rather large. Greece is the biggest debtor now of the International Monetary Fund. Greece got a loan in the year 2010 of something like 3,000% of its quota, the biggest ever loan by the IMF under rather debatable conditions. So this matters to the whole world, whether Greece can repay its debts. There was no accord on the 18th of June yesterday amongst the Eurogroup of European finance ministers, and now an emergency summit of the chiefs has been called now for the coming Monday. The big question mark for me is the loan which is outstanding to the European Central Bank. The European Central Bank bought Greek bonds in 2010, and some of these bonds are now maturing. And the ECB likes to think of itself as an even more prime creditor than the IMF. And to quote one leading German official, if you default on the ECB, you're dead. Central banks matter. And so this is really grave. Next slide, please. This is the only slightly amusing slide in the whole presentation. There are clearly parallels with James Dean and Rebel Without a Cause, where you see the scene with two cars hurtling towards a cliff, and I'm afraid to say one goes over the cliff. So I'm not trying to make light of the matter here, but this is an extremely serious situation where one of the cars could indeed go over a cliff. Next slide, please. These are the quite astonishing changes in the situation in Europe that we have had. And of course, we will be distributing these slides, if you don't have them already, so you can study them in greater detail. The most severe current account deficits that we saw in the run-up to the crisis, up until 2008, have been corrected. We had some European countries like Spain, like Portugal, with current account deficits of up to 15% of GDP, very reminiscent of the Asian crisis in 1997, 1998. So all of our friends in Asia will recognize these kind of figures. You've seen massive corrections. Most of these countries are now running current account surpluses because of the huge austerity. But rather ominously, you see the top two lines, the blue line and the orange line, that's Germany and the Netherlands. Their surpluses have continued to rise. And this shows there's been corrections amongst the peripheral deficit states, but not amongst the surplus states. And this shows a fundamental asymmetry in the system, which is one of the underlying causes for the turbulence. Next slide, please. The build-up in the current account deficits was accompanied by a massive loss of competitiveness. The blue line is Germany, and these charts obviously are inverted. So you see the relative unit labour costs going down for Germany, the blue line showing how Germany has actually gained massively in competitiveness since the system started in 1998, 1999. The other lines, you see the peripheral countries. Spain, for instance, is the red line, massive loss of competitiveness up until 2008, and then a regaining of competitiveness through the instruments of great unemployment and a big fall in activity. Again, rather ominously, Germany has continued to gain competitiveness since the financial crisis in 2010, whereas countries like France have lost. And so there's still an underlying problem of competitiveness in the euro area. Next slide, please. These numbers are things for you to study at home, I would say, over a glass of green tea. But they simply show that there has been now convergence at a low level of below 1% in the inflation rates. There was a lot of divergence early on up to 2008. This was one of the reasons for the underlying fall in competitiveness of the peripheral states. They became uncompetitive because they could no longer devalue. There is no deflation, ladies and gentlemen, in the euro area. There are one or two countries with negative inflation rates, but that's not the same as deflation. And therefore, the whole idea that quantitative easing was necessary in order to correct a sustained burst of deflation is not true. Quantitative easing was decided for other reasons, really to try to rescue the euro. So we've got a similar situation in inflation to what you have in Asia, but this is not a sign of panic. This is a sign of low activity and low oil prices. Next slide, please. This is, in fact, one of the most remarkable signs of divergence in the European Monetary Union area. Overall unemployment at around 11% is more or less the same as when the euro started at the late 1990s. In 1995, when Europe was just coming out of a painful recession, unemployment was more or less the same. But there's been an astonishing divergence in unemployment rates. If you study these when you have a little bit of time, you'll see that the German unemployment rate is more or less halved over this period of time. Some states are doing very well. One could quote George Orwell in Animal Farm: all animals are equal, some are more equal than others. In European Monetary Union, all nations are equal, some are more equal than others. Some states have done very well out of monetary union because they've increased their competitiveness and managed to increase their exports. Germany, Netherlands, Austria are among them. The peripheral states, as you can see, are in a real mess with very, very high unemployment rates, and that's driving a lot of political and social unrest. I'm afraid to say we haven't seen the last of that. Next slide, please. This is the quantitative easing of the central banks, just illustrating what I told you already. This is a chart that simply shows us the situation as of now. The one point I'd like to highlight here is the yellow line, which is the European Central Bank line. This is based on 100 in January 2008, so just before the crisis erupted. You can see that the European Central Bank has been relatively restrictive when it comes to expanding its balance sheet, and that's partly because of a very, very strong influence by the Bundesbank. It is now starting quantitative easing. One might say it's too late to really rescue the situation. It'll obviously help, and has helped, the upsurge in economic activity we've had in the last few months, but I don't think it's a panacea. And this explains what I called the great monetary polarization earlier on. Next slide, please. These are the net target balances, which is one of the statistics you must watch if you're looking for underlying Eurosystem strains. And these are the assets or the liabilities that individual central banks hold vis-a-vis the European central banks, which could be at risk in the case of a breakup. And you can see that the Bundesbank's assets, which is the top line, the orange line, peaked in 2012, have since fallen, but have by no means normalized. The lower lines, which you can see, Spain in particular, the yellow line, has again gone back from the very high liability position in 2012, but again has not normalized. These are really important because these assets, the Bundesbank's assets, 400 billion euros owed by the ECB to the Bundesbank, which the ECB has on lent, above all to Greece. These assets could be written down if there were to be any kind of wholesale dismantling, or indeed if one country were to leave the euro area. And the Germans, quite rightly, are very worried about the assets that they have at the ECB, which are potentially at risk. Next slide, please. This is a largely historical chart which shows how you had a tremendous normalization of the long-term interest rates for 5 or 6 years up until the outbreak of the financial crisis. Everybody thought that the euro area was converging. Everybody, that is, apart from people like me who wrote books to say that it wasn't actually converging. And we've since had the time of reckoning after the honeymoon. We had a big spurt in the Greek interest rates, as you can see, during the period of crisis 2010 to 2012. They came down a bit, but they've gone up, and this chart is not fully up to date. The Greek rates, of course, have risen now considerably since that chart was made. And I would say that in the future, whatever happens, we will continue to have spreads between the German Bund rate and those of the other countries. And this is a sign of the underlying divergence in the area. But it's also a sign of the markets doing their job properly. There has to be a pricing of risk. QE at the moment has overlaid this pricing but I'm sure we will go back to a more realistic pricing in which the spreads will continue to be there. Not extreme levels, but we will continue to have spreads in the future. Next slide, please. One of these charts which we like to highlight in particular is the credit debt imbalances. It simply shows that Germany, I think you can see that's the middle line, the grey line. Germany's credit balance with the rest of the world has risen tremendously since the start of the euro, when it had a balance of more or less zero with the rest of the world. It's now gone up to 40%. Japan, of course, is the world's biggest creditor, which you can see the net foreign credits of Japan, something like 70% of GDP. China, quite sensibly, has managed to reduce its net foreign credits. Germany's net foreign credits make the country, as one of the biggest creditors in the world, rather exposed to a euro area breakup. That's one of the underlying reasons why Germany does want to keep the euro area going, not at all costs, but certainly at a rather large cost, because it knows that its net foreign credits, much of it owed to the rest of the Eurosystem, or much of it owed by the rest of the Eurosystem, are at risk. Next slide, please. This shows the debtor position in Europe, and one of the most surprising and extraordinary signs is the green line, which I would really counsel you to study, and it's a rather warning sign. Back in the 1970s, the green line refers to France. France was a very solvent country and had a very large net foreign balance of its credits against its debits. France has since become a debtor country. You can see the UK, we are also a debtor country, but we've always had to live with that, at least for many years. France's swing from being a very high net foreign credit country to a net foreign debtor country is quite severe and quite alarming, and shows the underlying loss of competitiveness in France. The most extreme line is that of Spain, the blue line, and you see that Spain's net foreign debt is now nearly 100% of GDP. That's despite all the massive efforts that Spain has made. Debt tends to be something that continues, particularly in times of low inflation, which we have in Europe. Spain has been unable to get rid of its debt either through growth or through inflation. And this is one of the millstones, I'm afraid, that Spain has around its neck. It's not been allowed to have interest rates which are very, very low for its debt, apart from in the last few years. It has got to a current account surplus. The debt remains because of snowball effect of very low growth. And this is one of the really big, imponderable problems for the debtor countries in Europe as we go forward. Next slide, please. This is the world's main creditors. I put Singapore in there and Saudi Arabia's way. And you can see all these countries do have very high net foreign credits, and they are potentially vulnerable if the debtors default. But I would say they are less vulnerable than Germany, because Germany's net foreign credits now are very much concentrated on the euro area, and nobody really wants the Germans to with winning a great battle here without actually with their net foreign credits. The German credits are more at risk, I would say, because Germany is more politically exposed in Europe than, say, Norway or Switzerland is, partly because of the German history, partly because the euro area is very much tied up with Germany's position in Europe after reunification in 1990. Looking at those charts. Next slide, please. These are slides which you can look at your leisure, simply to show how the world's stocks of debts and credits have changed. One thing I would look at here is the United States, and we try to look at a lot of the world through this prism of the net foreign assets and liabilities. The net liabilities of the United States have increased tremendously over the last 10 years, and yet the US is still home to the world's reserve currency. You can have large debts and still be a very adequate and sensible player on the world monetary stage, which I think the United States are. So I won't comment on this slide any further. It's something for your bedtime reading. Next slide, please. Yes, so this is where we go into the 6 scenarios, and this is really where we're coming to an end now. The European Central Bank does make these emergency liquidity assistance allowances. It's actually loans by the Bank of Greece to the Greek banking system, but it's covered by the approval of the ECB, and it is those ELA payments which are now at risk. It's about 80 billion euros. In fact, it was increased this week to 84 billion euros. That could be cut off if there's any sign that the Greek banks are insolvent. And Mr. Curé, the ECB board member who's responsible for international affairs, was quoted by Reuters last night as saying he was unsure whether Greek banks would open on Monday. Now, I don't know whether he really said that. I don't know the context. I don't know whether this was a truthful statement. But I do say this is a very inflammatory position where an official simply says that and is quoted by a major news agency. And I don't know what the results will be on the Greek banking system. The ECB is prohibited from allowing ELA to banks which are insolvent. And there may be a reason for thinking that some of those banks are not completely solvent. And if that is the case, then ELA will have to be stopped. And that will be very dangerous. We've had several hundred millions of euros a day for several weeks, and there's been reports that this has risen to as much as 1 billion euros a day very recently. And faced with this hemorrhage, capital controls are clearly a possibility. Every time a euro leaves the Greek banking system, it is replaced more or less by various funding mechanisms, including the target balances, which I mentioned before. So the fact that euros are leaving Greece actually does increase the exposure, particularly of Germany, but also other creditor countries like the Netherlands, quite massively. So there is a big amount of money at stake here. Next slide, please. Capital controls, I think, are now increasingly likely. It's been flagged up as an issue now for several months in Europe. Don't forget, we've had the Syriza-led government since January, and so none of the crisis escalation that we've had in the last few days is really all that new. There could well be capital control similar to what we saw in Cyprus 2 years ago. And one of the ideas is that this could concentrate the minds of the Greek people, make them see that a real crisis is brewing here, and possibly make the Greek people more likely to give in to the creditors and decide more austerity. It could have the opposite effect. Nobody quite knows. But faced with these very large outflows, it could well be that we will see capital controls quite soon. The problem between the creditors and the debtors is that they both want different things. Pension reform is a major item. The Greek pension system is relatively generous, and the Germans in particular say they cannot stomach any package which doesn't include a watering down of the pension reforms that are being put forward. So next slide, we'll go through very quickly now since we're getting quite close to the end of the presentation. The creditors give way. This is very unlikely, but some people in Athens seem to think that the creditors might allow the Greeks more money without fundamental reforms. I would say the possibility of that is more or less zero. And in particular, countries like Ireland, Portugal, and Spain that have already endured great hardships would be extremely vexed about such a solution. So it's not just Germany here that's implacable, it's also the other debtor countries. So next slide, please. Yes, Greece gives way. This is what people are hoping for, and there has been a very strong statement from the Bank of Greece just 2 days ago saying there will be an uncontrollable crisis. And Bank of Greece is clearly pushing for the government to give way. On the other hand, Mr. Tsipras, the Prime Minister, and Mr. Varoufakis, the Finance Minister, have pledged many times, as has their party, that they're not going to give way. And it could just be this time that the Greeks are not bluffing and that they are prepared to go all the way towards being cut off from Eurosystem aid. Next slide, please. One of the almost inevitable outcomes of being cut off from Eurosystem aid following abrogation of the ELA and default on official debt would be for Greece to continue in the euro, but with a parallel currency. This halfway house would allow Greece, for an interim period at least, to remain in the euro. They would issue IOUs, basically, a domestic currency. You could call it the new drachma. This would exist in parallel to the euro. The euro would continue as the common currency of the eurozone, but it would not be the single currency. This would be conform with the statutes of the ECB and EMU for this halfway house to continue, at least for a few months. Next slide, please. This is the ultimate that Greece does leave the euro. Nobody knows what would happen. It could lead to an absolutely dire, catastrophic outcome. Greece could become an economically failed state. It could be very vulnerable to political upheavals. Or, and I actually do favour this more optimistic outcome, after a period of necessary and inevitable dislocation, there could be money flowing back into the country. Greece, I think, would remain in the European Union after leaving. This is a vexed legal point, but I think they would probably remain. And also, they would be the recipient of aid still from the European Union, even if they were not in EMU. Senior people have told me that Greece would find it easier to get aid from the creditor countries in Europe, even after defaulting on their debt, if they were outside monetary union, because there'd no longer be a ban on monetary financing. And certainly China, Russia, and the United States, for all sorts of reasons, would be giving money to the Greeks. So it would be very dire, but I don't think it would be quite the end of the story. So that's more or less the end of the presentation. You will see some remarks about OMFIF at the end, which you can read. But I'd like to hand over now to Hans, because I think I've given you enough facts, figures, conjecture, possibilities, catastrophes, and also possibly more optimistic outcomes. So I do hope that this has hoped, at least, if not to totally demystify the euro crisis, at least to make you still confused, but at a higher level. Thank you very much.
Thank you very, very much, David, for an extremely clear presentation. As you said, there are many possible scenarios, or at least 6 of them that you have listed, and I will not, unless you have already a probability estimates on them, I won't press you on that, but it will be interesting to hear what your views are, what the most likely outcome might be. But I have not yet received questions from our member central banks, and I urge them to take the opportunity to write in questions if you have them, because it's rare that we have such a knowledgeable person with us to be able to answer those questions. Let me ask perhaps myself one or two, and that is, suppose we have well, almost in any of the scenarios, one can imagine that there might be consequences for international financial markets, and also consequences for the way the ECB conducts its monetary policy. Do you have, David, any sort of views on what the extreme possibilities are, the good, the bad, and the ugly, so to speak, in that respect, for international financial markets, which of course then would have repercussions here in Asia and also for ECB policy?
Well, the ECB decided quantitative easing in January. This was the 60 billion euros a month purchases of government bonds, and that came into effect in March. This is highly controversial. The Germans don't like it and are continuing to make a big campaign against it, although they know they can't do very much about it because they've been outvoted so far in the European Central Bank Council. And this is, you could say, a fallback policy. It has protected some of the peripheral countries from the negative effects of a potential Greek exit. And some people say Mr. Draghi very cleverly, Mr. Mario Draghi, the head of the ECB, very cleverly has put in place a kind of buffer zone to protect some of the weaker countries should Greece leave. However, as I said earlier, QE is not a panacea. It's distorted the whole risk profile on bond markets. It's led to negative interest rates on some of the main bond markets in Europe, much to the displeasure, of course, of central banks around the world who hold these bonds. And there's been a sharp correction recently, as you all know, in the German Bund rate, which had been nearly negative for 10 years on 7th of May, and now 6 weeks later is around 1%. And so we've had more volatility, and I predict that this volatility will increase if we have a perturbation regarding Greece. And a perturbation is going to happen one way or the other, whether they stay or leave. This will not be plain sailing. So I think the circumstances in which ECB can carry out its quantitative easing are now under threat. If there is a major worry about contagion from Greece to other countries, were Greece to leave, there will be more market buying of German bonds, the safe haven instinct would come into play. That would make the ECB's policy of buying German bonds rather unworkable, because you'd be buying into a market that was already rather overheated. So that's one possibility. Just the other one that I'll mention is a rise in United States interest rates. We will be riding into the headwind of a moderate increase in US interest rates, possibly two such events later this year. This is going to actually expose some of the frailties in the European system and may make the QE policy more difficult to carry out.
Very good, thank you. I have received some questions from one of our members, and I go along the line with what I asked before. Which of the 6 scenarios is most likely? If Greece exits the euro mechanism, would that signal a bad precedent to other members, and will they? What is the likelihood that that others will also exit, and which countries are the possible candidates, and for what reason? And then there's more of a market question. What is the range of the euro and Bund if Grexit happens?
What is the range of the question?
That is, the question says, what is the range of the euro? I presume it has something to do with what will happen to the euro exchange rate. I actually heard on the radio here in Malaysia today that the euro strengthened today. Now, that can happen for many reasons, but they tried to make it a link with the crisis. It's hard for me to understand exactly why the euro should strengthen during a crisis period, but maybe there are some reasons.
Yeah, well, as we know, foreign exchange dealers can always think of reasons one way or the other for whatever has happened. It's always easy for intelligent people to think of reasons something has taken place. First of all, on the scenarios, of course, these are overlapping scenarios because it's quite clear that there's a sequencing. I think it is quite likely that the ELA will either be cut off or that the haircuts that the central banks apply to the collateral that is put up for the ELA will be significantly increased. So that's more likely, actually, that the collateral requirements will be made more tough. I've heard people talk about haircuts of 80% for the Greek government debt that is used as collateral for the Greek banks to borrow at this emergency lending window at the Bank of Greece. Of course, if haircuts were to be increased to that level, that would be almost the same as cutting it off. It would be a more elegant way of doing it. The Greek banks would no longer be able to fund themselves. I think that is a strong possibility, either a very big widening of the haircuts or a cap on the ELA of, say, 40 billion rather than 80 billion, or a complete cut-off. I think that must look like a possibility in the next week or so. There's the very strong possibility of a default on the official debt. Of course, it may not be called a default. It could be called a deferred payment. It may not go down officially as a default, although we've got this so-called drop-dead deadline of the 20th of July, which is when bonds are due to the European Central Bank. The ECB might decide some leniency. But as I said before, the ECB likes to think of itself as an even more senior creditor than the IMF. Clearly, the IMF is extremely important, and this 1.5 billion euros that is going to be repaid, we hope, by the end of the month, end of June. If Greece doesn't repay that, then Greece would be in the same position as countries like Zimbabwe, or Somalia, which didn't do that. it would really look like something of a pariah nation. So I would say the chances of Greek not repaying the IMF debt are also very high. In terms of leaving the euro, this doesn't have to happen straight away, as I said, but I think the chances that Greece will leave the euro, say, in the next 6 months must be, say, very conservatively, more than 50%. And I wouldn't like to say that this is going to be precipitous, because European politicians will always find ways of delaying anything unpalatable. One thing that needs to be said about all these scenarios is that politics will hold the key. The ECB and the Bundesbank are all saying now, it's not up to us, it's up to the politicians. Mrs. Merkel, the German leader, who's the most seasoned leader, been there for 10 years, she's particularly worried about a Greek exit. Why? Because a lot of her political future is staked on stability, and the German people don't like instability. Secondly, because of the geopolitics, the danger that Greece could become, as I said, a kind of failed state. Now, when it comes to the euro exchange rate, I think the euro will continue to be weaker on sentiment reasons, particularly as there will be a danger of other countries, such as Portugal, not following suit straight away, but certainly if Greece were to either leave or become semi-detached or go down this halfway house area, and particularly if Greece was to get further debt relief or be allowed to default without great consequences, if that were to happen, then politicians in Spain, in Italy, and in Portugal, who are all quite antagonistic about austerity, would say, why don't we do the same? So this will not be overnight. You will see this coming through in the next 3 or 4 months in a drip, 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 gradual way. I think the euro will continue to go weaker. Also, I do think the central banks will have other possibilities for their assets, in particular the dollar, as US interest rates start to normalize.
Thank you. I've received a number of additional questions. Let me take 2 at a time. I have 4 on my list. First, the first 2 are the following. Greece has already received a rescue package of various sizes, and so why is there a crisis? And the second question is, can the EU allow capital controls? Is this compatible with the EU rules on free capital mobility and so on?
Yes, the question about what has happened to the money is, of course, one of the most important questions, because the money has been paid over in the form of 200 billion, which was put up now 5 years ago in successive stages. And also there was a massive debt write-off, the biggest sovereign debt write-off in history in 2012, 5 times as big as the Argentinian debt write-off a few years ago. So what has happened to this money? It's mostly gone to pay off existing creditors, particularly amongst the private banks. There was a big worry in 2010 that Greece was massively overborrowed against private banks and insurance companies, and it posed a systemic risk to the whole of Europe. And so the official creditors came in, provided the money, which wasn't, I'm afraid, used to make Greece more competitive or to shore up investment or to build institutions for the future. It was going to pay off the creditors. It was a kind of Ponzi scheme, I'm afraid, under which new money came in to pay off the old money and to rescue, above all, the French and German banks. And this is not just me saying this. Karl Otto Perl, the former governor of the Bundesbank, some of you may remember, he died, unfortunately, in December. He said at the time in 2010 that money is being used to rescue the French and German banks. And so they are, on the whole now, 90% of Greece's government debts are now held by official creditors, whether the IMF, the ECB, or above all taxpayers through various stability mechanisms that we have. So that's been, I'm afraid, the shift that we've had. That's where the money went. In terms of capital controls, yes, that is possible if there are emergencies. The EU laws do allow for this. Cyprus brought in capital controls, and they were only lifted in May this year. So Cyprus, a much smaller economy than Greece, did have capital controls for 2 years. And of course, the IMF now does allow capital controls under extenuating circumstances. The EU, on the whole, has said that these would be possible and realizable if there is a natural emergency, such as an earthquake or major meteorological impact, the EU would have to bend its rules, but it would be possible. I doubt whether it is sustainable. Greece is actually a large economy. It's something like the 7th or the 8th biggest in the Eurozone. It's got 10 million people. It's a relatively large economy compared with Cyprus, and I do wonder whether capital controls could be maintained for more than a few months.
Right. Okay. Thank you. There are questions that are being screened, so to speak, on my screen. I don't know if you're seeing them as well, but in any case, let me take two that are related to the ECB. One is, what can the ECB end emergency liquidity assistance without political backing? Can they do it on their own? And the second one is, suppose Greece does default on its debt, what would the impact be on the ECB itself?
Yes, the political backing is absolutely essential. The mechanism would be that the president of the ECB, Mr. Draghi, would have to go to the European Council, which is the body that is representing the governments of all the EU states, led by Donald Tusk, the former Minister of Poland, and Mr. Draghi would have to get political backing for the idea that Greek banks are insolvent. The ECB, as a non-elected technocratic body, does not want to suffer the opprobrium of pushing the Greek banks and with it the Greek state into bankruptcy without political backing. So there's no way the ECB can act by themselves. In terms of default, let's say the European Central Bank did not get the compensation that it seeks because it would like to have the bonds repaid, something like 6.5 billion euros of bonds. Greek bonds fall due in July and August, some to the ECB, some to the member central banks. It would, of course, not like that. It's got some compensation, is held back. It's held back profits of about 1.7 billion that is made on redemption of Greek bonds at par. Greek bonds it bought in 2010, which since were redeemed at par, even though it bought them at substantially below par. So it's got some reserves here. And of course, to shoulder the loss of something like 5 billion euros amongst the very large European economies is not a big problem from a point of view of the credit standing of the ECB. It would not drive the ECB into negative equity. It would not lead to an instant need for recapitalization. It was set a very bad precedent that the European Central Bank would not see its credits repaid. And people, of course, would be worried about the other assets that the ECB does hold, not least through the target system. Those assets do reverberate on Germany, Netherlands, other large creditor countries. I showed you the figures earlier. These are much bigger. And if Germany were to suffer a haircut on its target assets at the ECB as a result of the repercussions of a Greek default, that would be much more serious. Again, Greece would not cause Germany to go bankrupt. The Germans would take the hit over 20 or 30 years. Taxpayers in Germany would have to get used to slightly lower living standards, fewer hospitals, fewer swimming pools, fewer public subsidies for the Airbus over a period of 20 or 30 years. It would be a big political event. It would not be a major economic event. Clearly, you can shoulder losses through the taxpayers, as we all know, in a surreptitious way, and you write off the net present value of loans to Greece over several generations. Politically, very bad. Economically, we could live with it.
All right. Now there are a couple of questions on the role of the UK in all this. One question is, what would be the consequences of the UK leaving the EU? Should that happen, and there will be, I presume, a referendum. And how would that interact, if at all, with the other aspects of the crisis? The second question is more about what the UK has done, can do, with respect to helping to solve the problem in the euro area.
Well, on the UK leaving the EU, I would suggest we have a separate webinar on this because this is a major issue. But just very briefly, the Greek crisis could have two outcomes on the UK, both positive and negative. Positively, it could help Germany in particular to see that having a credit-worthy country like Britain as part of the EU, as one of the many credit-worthy countries in the EU, could be extremely helpful. I happen to be British, but I don't agree with everything that the British government does. But I think on the whole, we are reliable and good business and political partners. So I do hope that this crisis could actually concentrate minds and make people see that Britain and the European Union do belong together, and we need to find a solution for that, and compromises need to be made. More negatively, there will be a referendum, as you say, and the atmosphere of crisis in the European Union does not make the European Union look like a good team to be part of. If you look at this like football, the British people want to be members of a first division or Premier Division football team. They don't want to be members of a football team that looks as though it's getting close to relegation. So it could have both of those consequences. In terms of what does the UK do in order to help matters, the UK has put forward the idea that Europe should integrate more. We don't want to be part of that because we think that it's best if you have individual countries looking after their own governments and their own solutions. We don't want to become part of the United States of Europe, but we think, the British think, that if monetary union is going to be a success, it does need political union as well. Britain wants to be part of the single market. It's a very important trading market. Britain is actually the biggest trading partner of the euro area. That might surprise you, but Britain is bigger than the United States and China in terms of our exports and imports. So it's extremely important that Europe does actually succeed and that it works properly. We think Europe should integrate more. If they don't want to do that, then I'm afraid that's a little bit unfortunate. Britain's not going to give any bilateral loans to Greece at this stage, while Greece is in a mess. But Britain and Greece are old allies going back many, many years, as are Britain and Portugal. And I'm absolutely sure if Portugal were to get into trouble, as if Greece were to get into trouble, then Britain, along with other credit-worthy countries, such as the United States, such as China, would be there prepared to help. But Britain is not going to spend taxpayers' money at the moment on Greece, while Greece has still got its own set of circumstances to deal with.
All right. Now, let's move to a more question which is more political in nature, and that is the following. If Greece exits the euro area, what are your thoughts about it going closer to Russia and China? And you mentioned yourself some political aspects of, excuse me, of the crisis, which have to do with the maybe having an impact on Europe's unified stance towards the Ukraine crisis, etc. So it seems to have international political consequences. What do you think about all that?
The Greeks know that they've got some very powerful cards to play, and this is one of the fascinating paradoxes of the whole situation. Because the Greeks are very weak, they know they are very strong, because people fear their destabilization, either economically or politically, if they were to leave the euro. And the Greeks are very clever people. They're using this fact. The fact that Mr. Tsipras apparently is due to go to St. Petersburg today, I believe, to join Mr. Putin in the annual Russian Economic Forum shows that the Greeks are playing the Russian card very assiduously. The Russians are playing this card very assiduously as well, because the Russians also are not interested in the euro area being fundamentally sound. I think the Russians do see quite some benefit in this turbulence that we have. And so there's a bit of stirring up being done on both sides. Regarding China, China has some obvious interests in Greece, absolutely straightforward business interests. There's port interests. Piraeus has been privatized to Costco, who I think want to make more stakes there. Infrastructure in Greece is extremely significant and important. Tourism is an industry that could be developed. Energy, it could be developed. And China, like many other countries, is looking for real assets to put in its reserves. So China will continue to be interested for good business reasons, I think, in Greece. Greece will find itself maybe without many friends in the euro area, and clearly it's caused a lot of disturbance. And Mr. Varoufakis is negotiating tactics, the finance minister, it could be said they leave something to be desired. They are somewhat unconventional. But Greece does have lots of friends for different reasons outside the euro area. And believe you me, the Greek people being as agile and intelligent and as worldly wise and as historically minded as they are, the Greek people will certainly be using those friends from different parts of the world if and when they do part company with the euro bloc.
Okay. I mean, maybe a disaster scenario, but do you think that an exit of Greece could lead to a breakup of the whole euro area and even further the European Union? Not a complete breakup, but significant strains.
Well, first of all, I don't think there is an automatic link between the Greeks leaving the euro and leaving the European Union. I know that's been put forward particularly by the European Central Bank. And in fact, there's no mechanism for a country to leave the euro without leaving the European Union as well. And the head of the European Parliament, Mr. Schulz, recently said there is an automaticity that have to leave the EU as well. I don't think in practical terms that is correct. I think that Greece would remain in the EU. It would not be a pariah state. It would not be ejected from the club completely. I think, it's like many of these questions, it's binary. You could, if you're optimistic, you could say that Greece leaving the European Monetary Union area, if that happens, and as I said, it's by no means certain it will happen, but I think the chances are growing, that could actually forge greater solidarity amongst the countries that remain. And they could say, well, look, we want to avoid a Greek calamity. We would like to stay together, and we will do everything it takes, to use that phrase, that we do stay together. But it could have the opposite effect. Nobody really knows, because there could be a contagion effect, particularly if Greece is seen to be doing relatively well. Let's say after 6 months, dust settles, money starts to flow in, you've got a new drachma, a much lower exchange rate, money which left the country or which never was in the country flows in again. Politicians, not the ruling government, but politicians in Spain and in Italy in particular could say, well, why don't we do the same? And it's this gradual dismantling rather than a big bang breakup that is so damaging. And also one more point I might add, all the European leaders' attention is focused on Greece and has been now for 5 years. And frankly, they've got far better things to think about. They have to think about improving European education, improving the institutions, improving infrastructure, laying down long-term investment plans so that Europe can compete better with the rest of the world, not least with Asia. And while all you people in Asia are getting on with your economic development, building railways, building roads, doing infrastructure, I'm afraid to say Europe has been rather distracted by this crisis. And this is an immense waste of highly paid technocrats and politicians' time.
Right. Just a thought about the IMF. Do you think the IMF comes out looking good? Do you think it will lead to some reduced influence of the IMF as a result of its involvement in the negotiations in a rather unusual fashion?
Well, I'm afraid to say the IMF has made some colossal mistakes, and this is not solely the fault of Madame Lagarde, the present leader, although of course she was French finance minister when the loan to Greece took place. This took place under Dominique Strauss-Kahn, the previous managing director. The loan was too big. As I said, the IMF it's got more money outstanding to Greece than any other country. And it was also done on the wrong terms, and it was actually unfinanceable. So there was a breaching, I'm afraid, of the IMF statutes in some serious regards. The IMF will not come out of this looking well. That's one of the reasons why Mrs. Lagarde has been going to many of these meetings. She knows a great deal is at stake. This will not help the plan for the reform of the IMF statutes to be approved by the US Congress, because American taxpayers' money is now at stake here. And that's one thing that concentrates the minds. America has got the biggest voting share, but also the biggest stake in the IMF. So if Greece defaults, there'll be a hit for the American taxpayers. There'll be a hit, of course, for the Germans, for the Japanese, every other country in Europe as well. China will take a hit. China's got a relatively small quota, but China will also have to take a hit. So it would be much more difficult for the IMF to argue that it should have a greater influence in the world. I think the IMF's technical capabilities have been put under huge strain here, and their financial capabilities as well. So this does not help anybody who's interested in a constructive world order with the IMF at the forefront. And I'm afraid to say in Asia, I think it's going to cause greater strains and a greater trend towards a kind of re-nationalization or re-regionalization of certain competences. China has been very statesmanlike, I would say, over this, and I do hope that China continues to take a statesmanlike approach and not bask too much in the discomfiture of the IMF. But it certainly increases the view that we do need a much more multipolar world order.
Very good, thank you. I think that is all. Those are all the questions, I believe, that have come in. If I have missed one or two, please excuse me, but we have more or less run out of time. Let me make two final remarks, and then I'll leave the last word to you, David. The first final remark, first of those remarks, is that I would like to mention that on September 7th, the SEACEN is organizing a policy forum on implementing macroprudential policies in emerging markets in particular. And David is going to come and chair the main panel in that at that meeting. So all of our members, please take note of that. I think it's going to be a very, very interesting and great event. Invitations have gone out to all member central banks. Second comment, again, I would like to thank David and OMFIF for providing their support and to this event. I think it has been extremely interesting and fruitful. And let me, with that, give the last word to you, David. If you have any particular thoughts, maybe some advertisement about OMFIF and its activities that you want to mention.
Well, thank you very much, Hans. Right at the very end of the presentation, there is just one shot about our geographical reach. I don't know whether we could put that up on the screen, Brian, but I'd like to say that we as an organisation based in London are very worldwide in our scope, and we do want to do more in Asia. Indeed, we are doing more. We met Hans in May when we were in Kuala Lumpur with our friends from Bank Negara. No, sorry, that was in March. We were holding a meeting with our friends from the Philippines in Manila in early July. Just about a month ago, we were in Beijing. We had a very interesting seminar with our friends from Renmin University, but with many people from PBOC attending on the SDR and the renminbi. We will be doing more and more meetings, workshops, seminars across Asia in coming months and years. This is what we do, and those lines on the map show the different countries that we collaborate with. I think we've had 130 of the world's 188 central banks at our meetings so far. We very much believe in the future of Asia. We believe that Asia has actually done its homework following the financial crisis in 1997, 1998, far better than the Europeans and the West have done. We follow very much what's going on in terms of AMRO, in terms of build-up of the SDR and the renminbi inside it. We follow the internationalization of the renminbi. We follow the greater use of Southeast Asian currencies in financing. And we follow what's happening with the IMF and the various attempts to make the IMF more multilateral. So I see this webinar as just one small stepping stone along the way towards further cooperation with us. We will be building out a series of regional offices as well in different parts of Asia and Southeast Asia. We very much look forward to collaboration with you, Hans. Thank you for joining our advisory board, by the way, and thank you for the excellent collaboration, you, Brian, all the colleagues at SEACEN. Many thanks from London. Enjoy the weekend that is now starting, and I do hope that we will continue this very fruitful dialogue. I do hope that the more optimistic scenarios that I've outlined about monetary union will come to pass, and that we can do more demystification at a high level in coming weeks and months. Thank you very much indeed.
Thank you very much, David, and that concludes our webinar for this time. Thank you.
Thank you. Goodbye from London.
Bye.